So, you look at Funko's fourth quarter earnings report, and on the surface, everything looks pretty good. They beat Wall Street's expectations on revenue, they beat on profit. But here's the thing, if it was such a clear win, why has this stock been absolutely brutalized for the last year? See, there's a huge conflict at the heart of this story. You've got this one single quarter of positive data fighting against an entire year of what looks like deep structural decay. The market is trying to figure out if management is actually rebuilding this company on solid steel or if they're just slapping a fresh coat of paint over a foundation that's about to crumble.
And that really brings us to the absolute core question of our analysis today, doesn't it? Is this the real deal? The start of a legitimate, durable turnaround for Funko? Or is this just a temporary facade, something that looks good for a moment, but is hiding much deeper issues that could bring the whole structure crashing down? Welcome to Iron Financial. Our entire mission here is to put company fundamentals like these to the test, to see what's really made of steel and what's destined for the scrap heap. We're here to help you forge a stronger portfolio. Whoa, hold on a second. Before we even get carried away with words like turnaround, let's get real here. A beat is a relative term. Beating expectations that were already in the gutter after a catastrophic year, that's not exactly a signal of booming health. Are we seriously supposed to throw a party for a company that's been bleeding out just because it bled a little bit less than the paramedics predicted for one afternoon? Come on. A single quarter doesn't just magically erase 12 months of, frankly, setting money on fire. We need to see the actual architectural plans before we start celebrating any kind of rebuild.
And that's exactly what we're going to do. You're right. Today, we are putting Funko through a full-blown financial stress test. First up, we're going to assess the real damage from the full-year collapse. Then, we'll shift and examine that fourth quarter fight back to see if there are any genuine signs of life. After that, we'll dive deep into management's 2026 blueprint for a rebuild. And then, and this is the most important part, we are going to actively look for the cracks in that armor. Finally, we'll deliver our verdict. Is this company steel or is it scrap? All right, let's get into it.
Yeah, I'm taking the lead on this one, because before you can even dream about the future, you have to stand in the wreckage of the past. You have to understand just how bad the damage really is. That fourth quarter might be a nice, fresh coat of paint, but we need to inspect the foundation first. And let me tell you, the foundation for 2025, it's nothing but rubble.
Let's just start at the top line. This slide tells you everything you need to know about the damage. Full-year net sales, just over $908 million. That's a 13.5% drop from the year before. Now, don't let that percentage numb you. In raw dollars, this is a staggering collapse. They went from over 1.05 times billion dollars in sales in 2024, all the way down to just over $900 million. That's a revenue hole of more than $140 million in just 1 year. That is not a dip, people. That's a cliff dive. The basic demand for what this company sells just cracked, plain and simple.
Now, let's look at what that revenue collapse did to their ability to actually make money. Their full-year Adjusted EBITDA, it plummeted by almost 72%. It went from a pretty respectable $94.7 million in 2024 down to a pathetic $26.6 million in 2025. You see, the leverage in this business cuts both ways. When sales fall off a cliff, the profits don't just fall, they evaporate. This is the sound of the company's engine seizing up. A 72% drop is a catastrophic failure of the entire operation.
And here, this is where it gets really ugly. The net loss. This isn't some fancy, adjusted, make-believe number. This is the bottom line, the cold, hard truth. A net loss of $67.4 million. For perspective, that's more than 4 times worse than the $14.7 million loss they posted the year before. This slide is screaming at you that the fundamental business model is broken. They're spending way more money than they're making, and the problem is getting worse, and it's getting worse fast. How can you even begin to talk about a turnaround when the hole they're in is getting deeper this quickly? So let's just put it all together. This table lays the devastation out in black and white. Just look at the gross profit line. It cratered from $434 million to $351 million. Their gross margin, the very core of how much money they make on each product, it corroded, dropping from 41.4% all the way down to 38.7%. Think about that. That means for every single dollar of product they sold, they were keeping less and less profit to cover all their other costs. Now, yeah, they did manage to cut some overhead, what we call SG&A, but it was like using a teacup to bail out the Titanic. The most damning part is right at the bottom. In 2024, on an adjusted basis, they actually squeezed out a tiny net income of $8.7 million. A year later, that swung to an adjusted net loss of $38.8 million. This isn't just a small crack, folks. This is a complete structural failure across the entire year.
All right. The full year damage is undeniable. It was a brutal, destructive year, no question about it. But an investor's job isn't just to look at the wreckage of the past. It's to find the green shoots, the first signs of a future. And while the full year was a total collapse, this company didn't just roll over and die. In the fourth quarter, they started to fight back. And if you look really closely, you can see the first signs that maybe, just maybe, a new foundation is being poured.
First, they stopped the bleeding on the top line, at least compared to what Wall Street was bracing for. You see, analysts were expecting revenue around $261 million. Funko came in and delivered $273 million. That's a solid 4.8% beat. Now, where did that come from? It wasn't just luck. It was driven by very specific product strength in things like K-pop Demon Hunters and their Biddy Pop line. Now, what that tells me is that they still have that ability to tap into the cultural zeitgeist and create products that people actually want to buy. This is the first steel beam being bolted into place.
Next up, the surprise on the bottom line. The market expected adjusted earnings per share of just 4 cents. Funko delivered 5 cents. Okay, look, I get it. It's a single penny. And yes, it's still down from the year before. But here's the crucial point. They demonstrated better than expected profitability in the quarter. After a full year of just hemorrhaging cash, to show any kind of discipline and outperformance on the profit line, no matter how small it seems, is a really significant signal. It shows that management is starting to get a grip on the controls again.
And this is exactly how they did it. This is the heavy lifting. Their overhead costs, SG&A, were down 12% from the same quarter last year. They took their spending from almost $103 million down to under $91 million. This is not a fluke. This is active, deliberate, painful cost management. They are right-sizing the entire expense structure to match their new, lower revenue reality. This is one of the most important signs of a real turnaround attempt, tangible, disciplined control over what you're spending.
And while the US market was a mess, Europe actually emerged as a powerful engine for growth. As you can see here, Funko's sales in the EU grew by 20% over the last year. That growth rate was double the rate of the overall European collectibles market. This means they are actively taking market share from their competitors. Funko is now the second biggest collectible brand in all of Europe. This isn't just them playing defense, this is them going on offense in a key international market. It provides a really solid pillar of support for the entire company structure.
A pillar? Or is it more like a single support beam trying to hold up a roof that's completely caving in? A penny beat on earnings, a revenue beat that still means sales went down year over year, and strength in one part of the world? Are we really saying that's enough to rebuild a company that just lost $67 million for the year? To me, it feels like we're admiring the new front door on a house that's about to be condemned. I need to see the architect's plan for the whole building, not just one room.
That's a completely fair challenge. The Q4 performance is not the finished house. It's just the footing. It's the proof that they can still pour concrete and make it set. So now we look at the actual blueprint. The real story here, the entire bull case, isn't really what happened in Q4. It's the detailed, it's the ambitious, and frankly, it's the make-or-break plan that management has laid out for 2026. This is where we find out if this is a real rebuild or just a paper fantasy.
And here it is. This is the whole ball game in one single chart. On the left, you've got that dismal $26.6 million in Adjusted EBITDA from 2025. On the right, you have the 2026 guidance, $70 to $80 million. Let's just take the midpoint. That is a projected leap of nearly 200%. This is the turnaround story. Management is standing up and telling the market they believe they can triple profitability in just 12 months. If, and it's a big if, but if they pull this off, the entire valuation for this company changes overnight. The question is, how on earth are they going to do it?
And this is how. It's not magic. It's a three-pronged operational assault. First, and this one is huge, they've renewed their key licensing deals with the big studios. The new terms mean lower minimum guaranteed royalty payments. That's a direct, immediate boost to their margins on every sale. Second, those overhead cuts we saw them make in Q4, those are now locked in, so they'll get the full year impact of those savings in 2026. And third, they are laser-focused on improving gross margin, targeting a range of 41% to 43%, which is a massive improvement from the 38.7% we just saw in 2025. These aren't just vague hopes. These are specific, structural levers that they intend to pull. So this is the really crucial part. This massive rebound in profit is not based on some heroic pie-in-the-sky sales forecast. Look at their sales guidance for 2026, flat to up 3%. They are not promising a sales explosion, they are promising a margin and efficiency explosion. This is a story all about operational execution. It's about doing more with what they already have. It's a blue-collar, heavy-lifting, gritty turnaround plan, which, if they pull it off, is way more durable than one based on just hoping for a sales miracle.
A blueprint is just a piece of paper until the structure is actually built. And this particular blueprint looks like it was drawn up for a building in the middle of a hurricane zone. So it's time to apply some pressure. It's time to do what we do here at Iron Financial and stress test this plan and see where the weak points are. Because from where I'm sitting, I can already see some major cracks forming in this armor.
Let's start with the balance sheet, the literal foundation that everything else has to be built on. At the end of 2025, Funko was carrying over $225 million in total debt. Now, what's really alarming here isn't just the number, it's the trend. That number is up by over $42 million from the year before. So while they're trying to fix the operations, the balance sheet is actually getting weaker, not stronger. More debt means more risk, higher interest payments, and just less room to breathe if something goes wrong. This is a significant load-bearing wall that is already showing serious signs of stress.
And let's talk about the external pressures. This blueprint seems to assume a perfectly smooth construction process, but there are some serious storms on the horizon that could derail this whole project. First, management itself is telling us that their Loungefly brand, a huge part of their business, is going to decline by double digits because they're cutting unprofitable products. So just to hit their own target of flat to plus 3% sales, that means their core pop business has to grow by high single digits just to fill that hole. That's a really big ask. And then you've got tariffs. Their plan assumes a 15% rate, but that is not guaranteed. I mean, just look at 2025. Tariffs cost them almost $40 million. Any negative surprise there blows a giant hole right through their margin improvement plan.
And this slide might just expose the single biggest problem with this so-called great turnaround plan. So the company comes out with this heroic, ambitious guidance for a $70 to $80 million EBITDA rebound. The middle of that range is $75 million. But then you look at what Wall Street analysts, the pros who follow this company for a living, were already expecting. Their consensus estimate was over $81 million. So the company's big, positive surprise was actually a guidance miss compared to what the market was expecting. They're trying to take a victory lap for a plan that is less optimistic than what the market was already pricing in. That is not a sign of strength.
And this quote from an analyst at Stock Titan just sums it all up perfectly. 2025 was weak, but guidance implies a meaningful 2026 profit rebound. The key word there is implies. It's not a guarantee, it's a promise. It's a high-stakes bet that relies on perfect execution, stable costs, a sudden resurgence in consumer demand for their core product, and a friendly economic environment. Given the scale of the damage we saw in the full-year numbers and the cracks we've just identified, that is a very, very risky bet to make.
Okay, we have inspected the wreckage of 2025. We've analyzed the fight back in Q4. We've laid out the blueprint for 2026, and we have stress-tested it for every weakness we can find. Now it is time to weigh all the evidence. It's time to forge a verdict and decide if this company is being rebuilt with steel or if it's ultimately headed for the scrapyard.
The bull case, the case for steel, is pretty clear. This is a classic high-risk, high-reward turnaround play. You've got a new CEO, a management team that is proving they can actively control costs with that 12% drop in SG&A. You have a fourth quarter that beat expectations, showing they can still execute. You have a legitimate growth engine in Europe that's actually crushing the market. And most importantly, you have a clear, actionable blueprint to nearly triple EBITDA, based not on wishful thinking, but on concrete operational improvements. If you believe management can execute this plan, the upside here is substantial. But the bear case, the case for scrap, is just as compelling. The structural damage from that 2025 collapse was incredibly severe, with profits and sales in an absolute freefall. The foundation, the balance sheet, is weak, and it's getting weaker with a debt load that just keeps climbing. The 2026 blueprint itself is incredibly fragile. It requires a key brand, Loungefly, to shrink, while demanding huge growth from the core business just to tread water. And the cherry on top? The entire ambitious plan still comes in below what the street was already hoping for. This is a company with too many headwinds and a plan with way too little margin for error.
So, we end right back where we began. You have a company at a crystal clear inflection point. It's a battered structure with a bold new blueprint. The question you have to ask yourself now is this: is that 2026 blueprint strong enough to not only fix the damage of the past, but also to withstand all the pressures of the future? Or will the cracks we have identified, the debt, the brand decline, the guidance miss, will they just widen under pressure and bring this whole structure down? That is the stress test, and the answer will determine whether Funko is forged into something stronger or if it ends up as scrap. At Iron Financial, we give you the analysis. The final decision on how to build your portfolio, well, that's yours.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.